Welcome back to the Phronesis Perspective. I'm Matt Ackerman, joined as always by Richard Osman. Hey, Rich, so what do we have for this month's Phronesis Perspective?
Matt, I wanted to discuss active versus passive investment management. I think it's important to discuss this topic so that our audience has a better understanding of their differences.
Okay, so can you explain to me the difference between active and passive investment management for our viewers, of course?
Well, yes, I can. You see, Matt, active management is a process, whereas your investment selections are actively managed. When the investment manager feels an investment selection is undervalued, he or she could potentially buy more shares. When the investment manager believes the shares are overvalued on a particular investment selection, he or she most likely would sell the shares. Whereas passive management does not buy or sell investment selections based on valuation. Investment selections are bought and sold based upon the amount being invested or being distributed from the account or fund.
Okay, that makes sense. But which one of these investment strategies, active or passive, which one's better?
Well, Matt, it's not that one investment strategy is better than the other. However, investors just need to know the difference.
Okay, so what are their differences between the two?
Well, let me explain in greater detail then. Within an active management strategy, your costs are normally going to be higher when compared to a passive investment strategy. This should be easily to understand in the fact that someone is doing research, someone's spending time analyzing investments. They want to know what to invest in and at what price, whereas that is not the case with passive management. However, since passive management does not look at valuation, it does tend to favor the largest companies in an index. My example here is that Apple, Microsoft, Amazon, Nvidia, Alphabet, and Meta represent about 26% of the S&P 500 index. What that truly means is that if you invest $1 in the index, you're actually investing about 26% of that dollar into these six particular companies. When there is a period of time where money is flowing into these indexes, these passive investment strategies will pump a lot of money into these six companies. If you were to examine how much money flows into the bottom 400 stocks on the S&P 500, that number would be approximately 31% of every dollar invested. And only about 3% of every dollar invested is for the bottom 100 stocks. As you can see, this style of investing tends to inherently favor the largest companies in the index.
Okay, that makes sense to me, but why is this a problem?
Again, I'm not sure problem is the word I would use. I mean, most individuals don't care what they pay for an investment, provided they make money from it. However, most investors are concerned what they pay for an investment. They believe that long term, the price you pay is an important factor.
Okay, so are you now saying that active management's better?
Again, neither investment strategy is necessarily better. However, they are different. One is more costly and factors human opinions. One is more cost effective, but less sensitive to valuation or human factors.
Okay. Is there anything else we should know about the differences between active and passive investment strategies?
Well, I will also add that active management normally keeps a certain amount of investment in cash. As such, they generally perform better in down markets. On the contrary, passive management usually stays 100% invested and will generally outperform in up markets.
So, do you have a preference?
Matt, I actually do prefer active management, but I also cannot truly state that active management strategies have necessarily outperformed passive management strategies, at least over the last several decades. There has been a lot more money put into index funds than active management funds over the last couple of decades. As such, it's sort of a self-fulfilling prophecy. We all know that stocks go up when there are more buyers versus seller. So it stands to reason why index investing has been a good performer. However, me personally, I'm an investor at heart. I personally value what I pay for an investment. So I do tend to lean towards more active management strategies.
Well, Rich, once again, Some great information, great insights, and great education is always about another great financial topic. This has been another incredibly educational episode of the Phronesis Perspective. I'm going to just ask that everybody hits that like button. Make sure to share across all your friends so we can get more information out there. For the Phronesis Perspective, I'm Matt Ackerman. He's Richard Osman. Have a great day.